All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey, hey, hey.
Mark, it's just after 10 a.m. here Pacific time on March 7th. It's Pizza Friday today. We got the payroll numbers, which we'll get into shortly. But it's been a pretty volatile week. A lot of uncertainty out there in markets, both stocks and bonds. But why don't we just kick off right into kind of the recap, the where are we for the week?
Let's do it.
All right, S&P down almost 4% on the week and on the month since the month end was last Friday. Looks like the best performer is healthcare up 37 basis points as of time of recording. Consumer staples up 20 basis points. Those are the lone two positive sectors on the week, so you can tell how bad that week was. The financials finally came back to earth. The worst performing sector on the week, down over 6.5%. Looks like consumer discretionary down 6 and tech down 4.5%. If we kind of look at the year-to-date, S&P is down 2.5%. Two sectors are negative on the year-to-date basis, though. Tech down 7.3 and consumer discretionary down 9.5. Everything else is positive. As I mentioned, healthcare, the best performer, up almost 9% on a year-to-date basis. So year to date and or I guess the week showing pretty different pictures out there from the stock market.
Yeah, we're getting a reminder that stocks don't just go up. We got 3 weeks in a row now where we're getting punched.
That's right. They don't just go up. If we think about the NASDAQ, we're down. We don't usually talk about it, but we're down over 4.5% on a week, 7% year to date basis, and looks like from the high in the NASDAQ was on February 19th. So what is that? 3 weeks ago, we were down over 10%. So a correction in 3 weeks. That's a pretty dramatic move there. If you look at that chart, it's pretty interesting to see how quickly it's gone down. We're back to levels of like October of last year. So kind of giving up all those gains in the NASDAQ, at least since the election, or I guess more than previous than the election. If we look at the Russell 1000, it's down 4% on the week. Russell 2000 down almost 5%. Growth down 5%, and value finally outperforming, but still down only 2.9% on the week-to-date basis. I guess from all these indices we look at, the S&P equal weight is the best performer, down only 2.3% on the week. So that equal weight advantage is showing itself in this kind of downward move, specifically in the market cap, with the tech being one of the worst performers and such a huge weight there in the S&P 500.
Still clinging on to that year-to-date positive, too.
Yeah, 50 bips,
Yeah.
0.5% there on a week to date. If we shift over to bonds, the 10 years at 427 as of time of recording, the 2 years at 395. Kind of an interesting move here where the 2 years down 4 basis points on the week and the 10 years up 6 basis points on the week. So a little bit of a reversal. The 10-year is pretty volatile if you look at it as I mentioned, 427 right now. It was down 5 bips on Monday, up 10 on Tuesday, up 4 on Wednesday, kind of flat yesterday, and then today it was it was down 1 basis point so far today, but it's been volatile today. So we'll kind of see how things shake out over the rest of the day and see how we end the week when the markets close there. But as you would expect, with the 10-year up 6 basis points, the fixed income indices are down. The ag is down about 30 basis points. Everything looks like investment grade corporate, the worst performer, down about 0.5%, but your treasuries and your agency mortgages both down about 30 basis points or so. Your riskier sectors are a little bit better. High yield down 0.25 point. Bank loans were flat, and emerging markets down 0.25 point also. So a little bit better, still negative there from those riskier side of things. If we look at a year-to-date basis, the ag is still up 2.4%. So at least that's a positive. Still kind of hedging your, I guess if you want to call it hedging your equity risk with your bonds has worked out so far on a year-to-date basis. The best performer there is agency mortgages. As we've been talking about a lot, agency mortgages were pretty cheap. Spreads were relatively wide. That has come in a lot over the past couple of weeks there. Agency mortgages up 2.75% on a year-to-date basis. And to round us out here on the commodity side, the Bloomberg commodity, actually looking at all the sectors, Bloomberg commodity was up 1.5%. All the sectors positive on the week. I guess if the ags are up 2 basis points, we'll still call that positive. Everything positive. Energy surprisingly is up 40 basis points on the week. I say surprisingly because crude oil is down 4%. We're at $67 a barrel right now. I show it's 67.05 here today. So surprising that with that big move in WTI crude, that energy is still positive. Must be that nat gas trade working itself out.
Cool.
As it's cold out here today. My dogs are inside for once. They went outside and came back inside. There was like, it's too cold out here for me.
It was same. It was 42 degrees this morning when I woke up. And the dog was not happy with that. Neither of them.
Yeah, that doesn't sound cold for most of the country, but for us here in Southern California, that's pretty cold. Industrial metals were up 4%. Precious metals up 3%. Looks like we got gold up 2.5% at 29.15 there. So still not over that 3,000 mark in gold. And then interestingly, Bitcoin up 4% or 4.5% on the week. It looks like it's 87,920 as of time of recording. With that, and that kind of wraps up the market recap for the week there, Mark. Why don't you kick us off on macro, which was a busy and important week?
It was. This was jobs week. So, of course, we're not going to start with jobs. We're going to start on Monday with ISM manufacturing, the PMI data for the month of February. This printed at 50.3. That was 0.4 below the estimates and 0.6 below the prior. We're going to take the shortest victory lap ever and say, hey, it's 2 consecutive months above 50. Something we haven't seen since October of 2022. So it's, good to see a little improvement there, but all is not clear. For the most part, looking at the details here, it's a mixed bag, as you'd expect with such a flat print. I'm going to pick out 2 metrics, though, to mention. You had new orders. We did have a 3-month expansionary streak that was snapped this month. It had a bit of a pullback to 48.6 level. And then also the prices metric. We're going to talk, sure over the next couple of months. And today, there's going to be mention of tariffs and whatnot. And well, not surprisingly, even though tariffs can get delayed, the commodity prices do respond earlier. And the report mentions spot prices being up considerably. And that leads to the highest prices metric we've seen since June of 2022. Within the report, there's anecdotal comments that are speaking to just uncertainty and volatility surrounding tariffs. And that seems like a theme we're going to have to get comfortable with for a little bit. Moving forward to Wednesday, we got the ADP employment change report for the month of February, the NFP early look. That printed at 77,000. That was 63K below the estimate and 109K below the prior. We don't dig too deep into this report, but I do want to give a quote from the chief economist. Quote, policy uncertainty and a slowdown in consumer spending might have led to layoffs or a slowdown in hiring last month. Our data combined with other recent indicators suggest a hiring hesitancy among employers as they assess the economic climate ahead. End quote. So uncertainty will be a theme that we touch upon numerous times. We'll
Yes.
Again, got to get used to that. Wednesday, ISM Services PMI print for the month of February. This came out at 53.5. That was 1 point above the estimates and 0.7 above the prior. This one, it extends our expansionary streak to 8 months because we had a couple dips below the 50 bound last year. But in general, this report characterized the entire thing as strong. Every single metric was above 50 except for imports. And while you'd like to think imports maybe is something we should take a peek at, given all the tariff news, about 3/4 of the respondents don't track that measure for the response or for the sake of responding to the survey. So I'll take that one with a grain of salt. It was basically right at 50. It's 49.6. But everything else is showing expansion. So I'm going to say this is still a pretty strong ISM services report. They again will make mention of anxiety caused by, the potential impact of tariffs and any ramifications that are going to come from federal spending cuts. So again, we'll have to deal with that as they come. Moving forward, also on Wednesday, we got the Federal Reserve releasing the Beige Book. This was their second of 8 releases this year. I'll briefly give you the summary of a summary. Overall economic activity, they characterized it as rising slightly since mid-January. They don't give the exact date for when the survey ends, but you can say somewhere around the end of February through the middle of January. On a labor market front, they say it nudged slightly higher on balance. On a prices front, they say prices increased moderately in most districts, although they did have several districts reporting an uptick relative to the prior period. So, economic activity marching forward, labor market steady, and prices rising. We're aware of those things, but that's not an ugly report coming from the Fed. On Thursday, we get labor data, the high frequency initial jobless claims for the week ending March 1st. This printed at 221K. That's 12K below the prior, 21K below the estimates. We'll call this steady as she drifts for the most part. We'll say that there's been some talk about an uptick in the federal employee initial claims. I'll give you that detail real quick. It came in at 1,634. That is not K. That is just one, call it 1,600 versus a trailing 1-year average of 413. That is the highest number of federal employee initial claims since 2022. If you look at the full history of this, not really a big deal if you didn't have any context to the story. This is kind of a normal vol, but the context here is definitely important. Probably going to have to get used to this rising a bit. We'll have to monitor this in the months to come. On the continuing claims front, for the week ending February 22nd, that printed in at 1.897 million. That's 23K above the estimates and 42K above the prior. Still below that 1.9 million high watermark we set back in January. Call that a local high watermark. So I'm saying generally, yeah, it's pretty still steady with this labor market data, the high frequency data, pretty stable here. That brings us, I'll skip ahead, keep us on the labor front to today. We got the change in the non-farm payrolls for the month of February. This printed at a reasonable 151K. That was 9K below the estimates, 26K above the prior. And we had a negative 2K negative 2K 2-month net revision. I'm going to characterize this report. I know it's not the strongest report, but it's not terrible either. I'll give you a couple facts to give that a little context. The headline print was 151K, 140K of that was private, only 11K government. That's again, government has been a big source of job gains. Last year, this time we had 71K get added. This year it's 11K. On the federal ex-postal service side, you had a loss of 7K jobs. So there's something we might need to get used to here. But nothing alarming within the report. I'd say that the most negative thing I'll take from this, and this has been an ongoing trend we've been seeing since it peaked in 2022, is the loss of temp worker jobs. That's was peaked at around, call it 3.18 million in March of 2022. It's now down to, call it 2.63 million. We've only had 2 upticks that entire downtrend period. So again, the labor market we know is weakening on trend, but the establishment data didn't come out extremely weak this month. Fortunately, the household data did come out pretty weak. Let me give you those figures. We have the U3 unemployment rate for February printing at 4.1%. That came in, it was 0.1% higher than both the estimate and the prior. You have the labor force participation rate came in at 62.4%. That was 0.2% below the estimates and the prior. And then you had the underemployment rate. That's the U6 rate for February that came in at 8%, versus, there's no estimate, but 0.5% above the prior. However you splice and dice this, when you look under the hood, the data is negative for the most part. It's a degradation within the household report. Part-time jobs for economic reasons. You had a 460K increase there. You had your employed decline, your unemployed rose. There's really not many ways to cut this to try and put a rosy spin on it. I want to highlight the U6 number and give you just a reminder on that color there. You've got various ways to splice the data from U1 to U6, the most refined at U1 and the broadest measure at U6. It takes the U3 measure and it adds a couple metrics. You take all the people, the U3, all the people who are looking for work, who are unemployed, and then you're going to add discouraged workers. These are people who they could get a job if they were looking, but they've just stopped looking. They are discouraged. It also adds marginally attached workers. These are people who they're not looking for work right now, but they have been looking for work over the past 12 months, sometime in the past 12 months. And then it adds part-time workers who want full-time employment but can't find it due to economic reasons. The number I just quoted that rose by 460K. When you boil that all down together, it gives you a broader measure of the unemployment situation in the country, and that's now hit 8%, which it's the highest we've seen since October 2, 2021, but it's kind of not fair to measure too many of these metrics purely against COVID. It puts us more in the context of the turn of the year from 2018, 2019. We rode a decade wave of improving labor metrics post-Great Financial Crisis up until the COVID era hit. But this is not an ideal scenario, but it is what it is. It's further degradation in the labor market. And that wraps up this week. Later today, we got consumer credit getting released at noon Pacific time, but it is what it is.
Yeah, Mark, I didn't think that. I feel like the market was maybe expecting a little bit weaker payroll number, even though the estimate was 160. I felt like the market was.
Yeah,
I guess the sentiment was so poor that we've had the past couple of weeks that people were expecting just more of a like, let's just it's going to be a lot worse. So it'll be interesting to see whether we can kind of stay at this 150 level, or whether it's just because it's so early and all the uncertainty out there, is not good for business, and whether that's going to flow through to payrolls in the upcoming months.
yeah, that's what any of these months we shouldn't overreact to single prints. I know we're
Yeah.
trying to focus on the trends, but again, with all the volatility, we're going to have the word uncertainty. It seems like quoted more than transitory. It's a very uncertain time. So,
Well, speaking of that, Jay Powell was speaking at the University of Chicago this morning. And the first quote I want to say is, he says, despite elevated levels of uncertainty, the U.S. economy continues to be in a good place. He also said that they, or we, meaning the Fed, does not need to be in a hurry, and that they're well positioned to wait for greater clarity. He mentioned that they still believe the path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. But that's a kind of a hint towards next week, which is inflation week here. So they see progress there. Tend to be slower than I think than the would like, or the Fed would like, but it is still there. And then also talking more about uncertainty and the policy changes. They did say the net effect of the policy changes, talking about like the Trump administration, this tariff policy, most likely, which is on again, off again, depending on the time of day. That the changes will matter for the economy and the path of monetary policy. They are parsing incoming information and a focus on separating the signal from the noise. And that he says, while there is, especially trade policy, uncertainty around the changes and their likely effects remains high. So he's, uncertainty there at the end. And as markets have tended to kind of overreact to what's going on, or the headlines, and whether tariffs are on or off, or there are exclusions for autos, or it's delayed a month. All of that kind of seems to be just kind of weighing on market and on sentiment there. Where are we in terms of Fed rate cuts? The market is pricing in. Oh, we're down to 2.9 cuts now. It was overreact earlier this morning, but we're at 2.9 cuts in 2025. We were at 2.75 last week, so not much of a shift over this past week or so. We're looking at a 4% chance of a cut here on the March 19th meeting. That'll probably stay very low, given the Fed is in their blackout period starting tomorrow morning. We're at a 40% chance of a cut in May, and then we finally in June get over 100% chance of a cut there. So it looks like June market's pricing in June, and it really does seem to be fluctuating daily, hourly, depending on what the headlines are. So we're in a very time of great uncertainty on kind of what's gonna happen going forward. So it'll be interesting to see how markets parse this out.
indeed.
Mark, you want to get into the things to keep an eye on for next week, which is inflation week?
Yeah, it's inflation week where we actually miss one of our inflation metrics, which is shocking. We don't get the import prices, import export, but inflation week begins. Let's see, we got NFIB Small Business Optimism Index. Last month we ended a 4-month streak of improvements for this. Estimated to pull back further. See how that comes out. It's estimated to come in at 101.0 versus a prior of 102.8. Also on Tuesday, we get the JOLTS job openings for the month of January. See, I do not have an estimate. I have not seen an estimate yet. We had a prior of 7.6 million. The JOLTS has been in a downtrend since March 2022, so we'll see how that continues to develop. First inflation prints, we get Wednesday. We get CPI for the month of February. Month over month, it's estimated to come in at 0.3. That is 0.2% below the estimate. Below the prior. We also get core CPI, estimated to come in at 0.3. That's 0.1% below the prior. CPI on a year-over-year basis is estimated to come in at 2.9%. That is 0.1 below the prior. And core CPI year-over-year is estimated to come in at 3.2%. Again, 0.1 below the prior. This is base effects, given these estimates for the month over months, you roll off a bigger number. And for the first 4 months of the year, we actually have some decent roll-offs that can help us chip away at these year-over-year numbers. After that, it gets a little tougher. On Thursday, we get PPI for the month of February. The headline month-over-month figure is estimated to come in at 0.3%. That is 0.1% below the prior. The core number, called the ex-food and energy month-over-month, is estimated to come in at 0.3%, right in line with the prior. And the year-over-year final demand is estimated to come in at 3.3%. That is 0.2% below the prior. I didn't see an estimate yet for core, but given the roll-off, we'll just say it's unchanged at 3.6. It has a roll-off of 0.31% versus an estimate of 0.3. On Thursday, we also get our weekly high frequency data, initial jobless claims and continuing claims. I did not have any estimates this morning, but we'll say just steady as she drifts until it's not. And that brings us, and that brings us to Friday. We get University of Michigan sentiment. I'd like to keep a focus on the 1 year, the inflation estimates. Usually don't like to talk about the 1 year number, but heard a lot of chatter about it after last month. We did have a bit of a spike to 4.3%. But more importantly, we did have the 5 to 10 year inflation estimate or expectations number. It spiked, actually, it printed at 3.3%, was revised to 3.5 in the final. That is the highest 5 to 10 year expectation since 1995. So a 30-year high. That is something that seems like worth monitoring, even though this is survey data. Like, we'll see how it develops. Again, one print can always reverse, but we'll see where it comes in next week. And then the week after, I'll front run it. Then we'll get import prices. Unfortunately, they have to wait a week. But that wraps up. Yeah, that's what we got on deck for next week.
All right, sounds like another busy week. We'll see whether how that inflation comes down. I do think that, as you pointed out, the higher levels from last year gives us some hope that CPI finally start to trend downward. I do see that we do have the estimate, the core estimate, core CPI estimate number is 3.2 for next week. So a little coming down a little bit there. And the JOLTS, they did update it, and it's expected to actually pop a little bit to 7.725 from 7.6.
All right.
So we'll see. That's whether that trend reverses or not. Again, we'll wait and see what the data comes out here.
It will take some stabilization at the very least. And
exactly. Right. But let's see what happens. But that's it for this week.
Yes. Thanks to our listeners out there today on DL Minutes. Hit us up on the X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget, our YouTube channel is youtube.com/DoubleLine Capital. We have Jeff Sherman's appearance on CNBC from earlier this week up. So that Jeff's always good there on TV. And then also we have Ken Shinoda's Channel 11 video titled Whipsawed. It's got some pretty good charts. I thought, I watched it this morning, so I thought that was a good video there from Ken. It's pretty short, about 14 minutes. But he goes over a lot of information in that very short period of time. So thanks for tuning in, and hope everyone has a great weekend.
And thanks everyone out there. Stay safe.
This presentation was recorded on the date indicated. Views and opinions expressed herein are those of the individual and do not necessarily reflect the views of DoubleLine Capital LP, its affiliates, or employees,